Hello, good afternoon, everyone. We welcome you to our webinar today. Thank you very much for your time to taking your time to attend this session today about a very pertinent topic, which is confronting equity investors today. We hope you will find the session interesting and informative. Before that, we take a few minutes to introduce our company, Trustline Holdings, and the speaker for today's session to the participants. Trustline is a 15-plus-year-old SEBI-registered alternate asset management company based out of Chennai. We are a small cap specialist and a meticulous practitioners of value investing. Our asset under management today is around 800 crores. We have built a very enviable client base of C-levels who form majority of our 600 plus clients. Today's session is going to be anchored by Mr. Arunagiri, who is the founder, CEO, and Chief Investment Officer of Trustline. Arun comes with more than 2 decades of investing experience. Today's session will last approximately 40 minutes. About 20 minutes will be taken by Arunagiri to give a brief overview about what he thinks about the markets and what he sees as the current situation, followed by a question and answer session. Thank you. Over to you, Arun.
Thank you, Govind, for a nice introduction. Good afternoon. Welcome all of you to this webinar. Thanks for participating on a weekend. I really appreciate that. As Govind said, this entire session is going to be structured into 2 parts. So initially 15 to 20 minutes, I'll spend my time in the topic and then throw the floor open for Q&A. So overall, we would like to wrap the session in 40 minutes max. So that's the plan. Let me straight away dive in. So we are going to be talking about this topic, broad strategies for bottom-up stock picking. Before I get into it, let me spend some time on the current market environment. That will kind of, give you context of the overall discussion. So the markets are, in a very, very interesting phase. If you look at the inflation and interest rate outlook, they are so dynamically changing. Markets are finding it difficult to deal with. Let me explain why. So if you want to track the inflation outlook, the easiest way to track inflation outlook is to look at some of the lead indicators. There are 3 key lead indicators which we closely track in terms of understanding markets view in terms of what is the inflation projections, right? What exactly markets view on the inflation. So one is the US 10-year yield, Treasury yield. The other one is 2-year Treasury yield in US and the dollar index. And these are 3 key metrics we look at very closely in terms of understanding where the Fed is thinking, what the market is thinking about Fed, etc., etc. So if you look at these 3, metric, they're all over the place for the last 3-4 months. So it's been extremely volatile. This is, I think, the Treasury yield, the kind of volatility which we are seeing in Treasury yield, probably for a decade we have not seen in the US Treasury yield. So if initially, if you look at, late 2022, the market view, the expectation from the market was Fed has been reasonably successful in tackling the inflation, and the trajectory was moderating, and the view from the market was more confident that Fed probably is looking at a peak rate of 5% and they'll be done with that. With that kind of view, the dollar index, which was close to 114.15 in September, October, crashed all the way to 101 in early Jan, late December 2022. And Treasury yield again cracked, it went all the way beyond 4%, which cracked again far below 4%. And 2-year yield also slumped. So that was the case in December 2022. And then come February, somewhere early February or mid-February, there was a shocker from the inflation front. And you saw inflation firming up sequentially in the US. Suddenly the market started, getting jittery about what the Fed will do, because the inflation is refusing to go. The trajectory, though it's moderating, but it's still, firming up. It's still elevated level. So then again, the market changed its view, saying, Fed is not going to be satisfied with 5%. Probably they'll look at 6%, 100 bips more, and they're going to tighten further. And as a result, again, all the three metrics, changed. The 10-year Treasury yield again went beyond 4%, and closer to 4%, not beyond 4%. And then 2-year yield firmed up to close to 5%, which we have never seen before. And the dollar index started firming up. So that was somewhere late February, early March. Then your accident happens, Silicon Valley Bank and 3 banks failure, regional banks. Kind of failure in the US, and then you have Credit Suisse accident in Europe. Again, the market, went through a kind of rethinking. Okay, with all this financial stress in the system, will probably, Fed will have the stomach to go the full course of, raising another 100 bips. And market started penciling in, and probably, this time Fed will go for a pause, or maybe they'll go with the smaller hikes of 25 bips. So you have a Fed meeting coming next week, mid of next week, and probably the market is expecting Fed to be a little more, less hawkish. So as a result, again, you look at the Treasury yield, it all the way came from, within 15 days, it came from 3.95 to close it up to 3.43 overnight yesterday. And dollar index again is slowly moving down, though not collapsed, but it is showing kind of weakness. But the biggest action happened on 2-year US Treasury yield, which is it slumped by over 100 bips in just about a week's time post that SVB, Silicon Valley Bank accident, 100 bips. This kind of movements we have never seen. So these are so volatile times, and the market really doesn't know where it is headed. Next week we'll know whether Fed is going to be taking this financial stress as a caution and then stop, go for a pause. But if you have any indication, look at ECB, right? Even in spite of the Credit Suisse event, they went ahead with a 50 bips hike. So market's expectation, one is not sure whether it's right that they will go for a pause. So we will know next week. So things are so volatile in terms of the global markets. So within this uncertainty, there's fairly one thing is very clear, that inflation, bringing it down to 2% from current 6% level in US is not going to be easy for Fed. And Fed is going to be struggling to get those rates, target rates. So which means the Fed is going to be, keeping the elevated interest rates for much, much longer time than probably initially we thought about 6 months back. So that's a kind of situation in global uncertainties. Now that's one part of the story. The second story is more interesting. Shift your attention to India. And this, suddenly one is seeing the macro improving dramatically. The reason why I'm saying this is because of the latest trade data, which came just about a couple of days back. For the first time ever, you have a trade deficit, which is including goods and services, is very, very close to break even for the month of February. It is just short of less than $3 billion. It has never happened. Now you have goods and, goods side, you have a trade deficit of about $17 billion for February, and you have a surplus in services of about close to $15 billion. So your net, you're about $2 to $2.5 billion. This has happened. The credit goes to the huge surge in exports in service. So the service surplus has really gone up. And service surplus, which used to be $6 billion pre-pandemic per month, is now moved up to $12 billion per month. And the estimate is probably in the next couple of years, it'll go even overshoot $20 billion per month. So this has made some of them to wake up in terms of current account deficit. Now the economists, some of them are estimating that for FY24, the current account deficit will probably be much less than 2%. They are penciling in close to about 1.6%. It has never happened. 1.6% in such earlier negative cycles, whenever the, earlier Fed tightening cycles, our current account deficit used to be the huge issue for India in terms of India's macro. It used to shoot up to 3.5%. As a result, it used to put so much pressure on rupee. And as a result, because of rupee, cracking down, which in turn used to pull down the equities. That used to be the Not many years ago, in 2013, all of us would remember those fragile days. Current account deficit is what in those down cycles which led to such issues. Now we have come long way from those fragile days. So what has led to this? That's very interesting. This is where I think one needs to look at the broader global trends which are favoring India. As we highlighted in many other forums, there are three broad global trends, right? Which probably I think India is the only country which is benefiting from all these three broad global trends which are playing out post-pandemic. One is the digitization, then deglobalization, and then decarbonization. These are three larger trends where India is benefiting. The credit for huge improvement in the external trade, external profile of India goes completely to the first two trends, digitization and deglobalization. Let me explain. In digitization, let's take that as an example. Like, for example, now we are looking at, there are some estimates which tells you that for every dollar which is spent on the cloud, there is $3 to $3.5 which goes as IT services business for Indian IT services. So you can imagine what kind of, that's one of the reasons why IT services companies have been doing well for, last 2 years post-pandemic. But that doesn't explain the sudden jump in service, surplus. There's one more reason. That secret is probably in the subsegment of IT exports, which is the GCCs, the global captive centers. There is an interesting data which tells you in the last 2 years, the GCCs numbers have gone up by 50%. And the exports, the kind of exports and professional services done by captive centers today accounts for 25% of the total IT services exports of India. And now coming to the next trend, which is deglobalization, which is basically a diversification of supply chain away from China and probably to some extent Europe plus one and all that, where India is the only beneficiary. India is one of the beneficiary. Again, let me give you an example. Electronics exports is the one which has grown hugely this year. And it's easy to see the reason. For example, now Apple, they manufacture almost 5 to 6% of their global requirements in India, iPhones. And the plan for Apple is to move this 5 to 6% to 25% in 2-3 years. We are talking about $5 billion exports for Apple to $25 billion in next 2 years. So there is huge headroom for GCCs. People are saying that GCC can go global captive centers, which post-pandemic people have accepted India as a destination for putting up IT shops. And most of it is R&D outsourcing and engineering and R&D outsourcing in GCCs. Like, for example, it is not only limited to technology companies. In Chennai, we have AstraZeneca, which has got the global research IT center in Chennai, which is ramping up. So such things are happening very, very widely. So it's question of time before, if you include service exports and goods exports, it's question of time. Probably India will get into surplus, which is never heard of. This is one large trend which is playing out. Third one is, which is decarbonization, which is green energy, hydrogen, where India is taking leadership and which is fueling private investment demand. So with all these, what's happening is in earlier down cycles, your imports used to degrow so much and exports used to degrow so much in a down cycle. When down cycle, what I mean is Fed's tightening cycle. Today, we are, holding up. If you look at the latest data of even for goods in February, it is down by only 8%. Imports is down 8%, the exports is down 8%. So, you could look at the neighboring countries which are banking on traditional imports and exports. What is their status? The reason why India is shining among them is because our export profile, our external profile, trade profile has dramatically changed because of these three larger trends. So, but one thing we have to keep in mind here, this, in addition to that, I would like to emphasize some of the other tailwinds India has got in terms of the macro. Which I'm sure a lot of you would know, a lot of forums it has been emphasized. One is, we are just coming out of a huge negative credit cycle. Post cleanup of NPA, we are just coming out of the credit cycle. It has extended for 6-7 years, and we are just coming out of a decade-old property cycle. And The tailwinds like the low base effect of cumulative low base effect for 7-8 years. So, for India, I think the tailwinds for macro is huge. Now, having said this, though the medium term to long term prospects are looking great for India, the India story is yet to play out. One thing we need to keep in mind is the short to medium term, the markets are not going to recognize this and run away with a huge momentum. Not likely to happen. The medium term, short term movements in the markets are going to be dictated by the flows, financial flows, right? Not so much by your longer term trend. So in that context, I think given this visibility that interest rates are going to be elevated for longer time than what we initially thought, and Fed is not going to likely to ease for much longer time, and probably they will go up to 6%, which is 100 bips more. The markets are going to be volatile. I don't think it's going to get any momentum anytime soon, even though there is a huge projection in terms of FI reallocation, longer term reallocation from China to India, which will still play out over a period of time. There are some estimates saying that in, couple of, maybe if you take a few years back, if there is $1 invested in India, $5.5 used to go to China. People are expecting in the coming years, this one will move to 1.5, and probably China will stagnate around 5. So those kind of reallocations are going to happen, but it's not going to happen immediately, but over a period of time. So in the immediate term, how do we see the market? It is not going to get the momentum. That's very clear for some time. I don't know until the dust settles on the Fed tightening cycle, until the visibility comes in terms of inflation trajectory. Until then, the markets are going to gravitate, drift like how it has been drifting since 2022 beginning, right? It has gone nowhere. It's been going all around, but in net, I think market is staying where it is, right? That is what is likely to happen. But within the market, I think the market would move more towards, gravitate more and more towards value than growth, because the hot money is not going to come. Growth will get less and less rewarded, and value will get more and more rewarded, like what we have seen in the last 1.5 years. Go back and see from March 2022 to now, it's bottom-up stock-specific market, bottom-up stock-specific actions are getting rewarded, value is getting rewarded, but growth is getting punished, or they don't get the attention which normally they get in an upcycle. So we don't see any change in this direction of the market in terms of value getting more valued, market gravitating towards more value, and more stock-specific, bottom-up stock-specific opportunities getting rewarded. That's the way we see it. So how do we navigate this market? This is where I think we come back to the topic, which is bottom-up stock-picking strategies. And, that's how you have to navigate, whether it is going to be 6 months, 1 year, 1.5 years, how this market is going to be drifting, we don't know. At some point, again, Fed will, complete its work, and then the market will start seeing more flows and the momentum will come back. And until then, I think the markets are going to be rewarding more and more stock specific. So you got to structure your portfolio more and more stock specific, more and more value oriented. The key question investors will ask, how do we identify such opportunities, right? The globally macro is bad, your export numbers are going to be less, and there is a noise of recession, slowdown, hard landing, and so on. So how do we identify companies? Every company will have some exposure to exports. Every company will have exposure to global business. So how do we identify? I think we got to look at businesses. I can give some examples at the broader strategy level, right? The way to look at is to look at companies which are fundamentally strong, which have got financially clean balance sheets, and then return ratios which are high, strong, but going through some kind of setbacks in the short term, so that you get these companies at discount, because only value gets rewarded in this market. You got to buy these companies at a real good value, so that there is some kind of unlocking happens because of stock specific actions, right? So that's at a broad strategy level. Strategy level, you got to look at companies which have temporary problems, but they have a business model which will sustain in the medium to long term. Let me give an example, because just to do justice to the topic which you've chosen, I'll give 3-4 examples, not mentioning the names of the companies, but how do we go about stock picking? Like, for example, you take a business, there is a business which is into quartz kitchen sinks, right? Uh, Bulk of their company's business comes from US and Europe. Of course, this geographies are in trouble, and new homes slow down. All of us know, because mortgage rates have gone up to 6-7% in US, and there's going to be a dramatic slowdown in the housing market in US. In that kind of setting, people are worried this business will it do well. The stock price is cracked almost 50-60% from the peak, because there's a noise about US recession and huge deep slowdown in housing market. As a result, this things business will come down. That's a very superficial way of looking at it. And it has come down 50-60. It's well-managed company, high return ratios. They carry a very, very high quality. It's a high quality business. Now look at it a little more detail. The same business, you look at the structural trend which is shifting within the US. Traditionally, a lot of houses are using steel kitchen sinks. Now that is changing dramatically to quartz, which means if there is a 15-20% of the households which are using earlier quartz, now that ratio is likely to go up in the next 3-4 years to 35-40%. Let's assume that there is a ratio like that. Which means, irrespective of the slowdown in US, because the underlying structural shift happening from steel heat sinks, kitchen sinks, to quartz kitchen sinks, there's going to be this particular business may not get impacted so much by the housing slowdown. Once that thesis is clear, then you go dive a little more deeper and see what this particular price, which is 60% down, 50% down from the earlier highs, when everybody was talking about housing boom in US, whether it offers you value. Probably 1 or 2 quarters down the line, when the results come, quarterly announcements come that this business has not been so much impacted in spite of the US housing slowdown, then the market would re-rate. So that's the kind of opportunities you got to look at. Like that, you get, there are business, engineering business. Let me give you another example, which is into timing belt, which is a very, very small niche business, which is, India, probably 1 or 2 players, a lot of it is imported. And so they also export a lot. Now, in terms of, business, though there is a slowdown, for timing belt in engineering exports, there's a lot of supply chain shifting, which is helping this company because of China plus one, plus, general diversification. Nobody wants to rely on single supply source now. As a result, his order book is improving. But the market today is derated the company because there's going to be a slowdown in exports and from Europe and US. But there's an underlying shift happening and the order book is increasing. So those things you can track and look at those kind of companies. Again, the company has a potential to get re-rated once, a couple of quarters away, the results come, and then the investor gets more confidence. Okay, this is not so much of an impact from this slowdown. And then you get the unlocking benefits. Similar thing in pharma. But broadly, I think when you are going about stock picking, the larger focus has to be on domestic focus sectors, because there's so much of global uncertainties. And we know that the macro for India is so good and it's improving. I think one should start looking at, basically screening companies available which are largely focused on domestic. And then find companies, because the overall sentiment, they give you value, and pick them and stay invested for long to unlock value. The other thing is the forging company, auto ancillaries. There's every part of this segments, even though they're exposed to exports, forging as well as auto ancillaries, the supply chain diversification is helping some of these companies. You got to look at them stock specific basis. Or some of these auto ancillaries which are now coming out with some kind of electric vehicle diversification. There's one company which we look at very seriously, which is into fasteners. Now, fasteners business, probably a mature business, it will go through certain type of cycles in this kind of down cycle. But then they have got recently into MCUs, motor control unit, which is into electric vehicles, and they've got a huge order book. The top 3-4 electric vehicle two-wheelers, they buy from them, and there is a good potential there. So you got to look at those kind of, specific niche bottom-up, scenarios to pick those companies, and you get those companies at a better valuation because of mispricing by the market. One, because of the weaker sentiment, and the other one because of the fear of huge, deep slowdown globally. So that's how you can look at, that's how you can navigate through bottom-up stock picking. And I can give many examples, but probably if you have question and answer session, I can address more of that. So when you navigate like this, there's again another question which the investors think, by navigating like this, do you make real good returns? Because markets lack momentum and they're not going to come back. You're yourself saying that the market momentum will come back only a little later. But by navigating through bottom-up stock-specific stock picking, will you make decent returns? Here I have to share with you how we have done last 1 year. Last 1 year post October 2021, I think the market has been drifting nowhere, like what I said. And it has been rewarding value and bottom-up stock picking. And I have 4 clients. Of course, for confidentiality reason, I can't share the names of the clients, but people who have come in April 22, March 2022, Jan 2022, February 2022. In all these cases, let me tell you, our portfolio has delivered closer to 15% return, vis-a-vis -2 to -8% return in small cap index. We are a small cap specialist. So we benchmark against BSE small cap. Our portfolio is structured, built around small caps. In our entire portfolio, we don't look at anything beyond small caps. So our right benchmark is small cap index. In the last 1.5 years post October 2021, small cap index has been bleeding. It has been around that -2 to -8% in all these 4 client portfolios. And all these client portfolios, the absolute return has been 13 to 16% for us. We have not done any rocket science here. We have simply stuck to this value strategy, bottom-up stock picking, and phased deployment, using the volatility and market cycles to our advantage, which is what we've done in the last 1 year. Markets have gone through cycles after cycles. You will have one SVB accident, one Credit Suisse, or something else will come. Market will get scared. So this is the way it's going to be next 5-6 months. I don't think you will see a big momentum in Nifty and Sensex. Very unlikely, unless there's some clarity which comes on Fed tightening cycle. So if it's going to be like this, if we can navigate, we can still deliver. We can still look at a kind of a decent returns of 13, 15, 15% in spite of market lacking momentum. So in a way, this approach is going to be like, ride this volatility. One, by picking up stock picking and building a portfolio bottom-up basis. You're riding this volatility with a decent returns. At the same time, you're also positioning your portfolio for much larger gains when this momentum comes back. We don't know when, only in hindsight we'll know when the momentum is going to come back. But when it comes back, you're fully structured for the portfolio to unlock dramatic gains when the momentum comes back. So it's best of the both worlds. That's what I wanted to highlight. With this, let me conclude. Okay, thanks a lot, everyone. And thanks for taking time off on a weekend. I hope you enjoyed this session. I really enjoyed giving this session. And so thanks a lot once again. Look forward to the next one. Probably, every quarter, every 4 months, we plan to do this on a regular basis. And thanks for participation. Thanks once again.